Yes.
Okay, let's hope the third time is a charm. We apologize to everyone out there who was trying to fix your computer. Your computer is not broken. We are broken. I accidentally stepped on the microphone this morning. Anyway, today's presentation, which is already 3 minutes of educational value to you, is going to begin. The presenters are Alan Gassman, an extremely mediocre presenter at best, and not even a good tax lawyer, and the amazing Professor Jerry Hesch when he shows up. All right, as always, we will provide you with mathematical prowess, information, and other stuff that will make your head spin. Sorry, folks, that's as good as it gets. And now to the first presenter. All right, everybody, welcome. I'm sorry that we were having some sound issues there in the beginning. It was actually the very best part of the presentation, the part that you missed. I am Alan Gassman, and I'm making no apologies for who I am and what I am. I am here to talk for 2 hours, it will seem longer, about some important things, including the Notre Dame Tax and Estate Planning Institute that is going to be held September 20 through the 22nd. That is a Wednesday afternoon, a Thursday and a Friday, followed by the football game in South Bend, Indiana. So if you've never been to Notre Dame, you're a tax professional, or you want to know about taxes and you want a tax deductible weekend there, you can talk to your tax advisor to see if you are a trade or business. If you are not a trade or business, you could talk to your tax advisor about becoming a trade or business so that you can write off your trip to South Bend, Indiana. At the Notre Dame Tax Institute, there are a significant number of faculty members and some quite amazing presentations. And when Jerry Hesch joins us in a few minutes, which would be supposedly 10 minutes ago, we will go ahead and cover that. I'm going to go to the beginning of the PowerPoint now, which is a novel approach for us. If you came in through CPA Academy, you are going to get 2 credit hours. You have to answer, I believe, 6 of the polling questions. There are 8 of them. They are extremely difficult. You will need 2 number 2 pencils in order to answer these. You are not allowed to use calculators or computers or call your aunt, especially if your aunt is an accountant. Jerry, did I hear you come on? No. Okay. If you came in through our website to watch this webinar, if you're a lawyer, you're going to get continuing education credit from the Florida bar, or otherwise no credit. You're just here to have fun. All right. Then how do you ask a question?
Listen, I'm in, but somehow I can see you, but I can't hear you, and you can't hear me.
I hear you now, Jerry. Josh,
can you hear me now?
Yeah, I hear you now. You want to sing something to make sure?
Okay, but if you can hear me now, I can't hear you.
How do you know I just said that then? I guess you can't. Josh, you want to figure this out? All right. So I'm gonna do the first polling question. Is that okay, Josh? The first polling question, which is an unfair question to ask you because you haven't even seen the software yet, is would you like to beta test our EstateView software? And the answers are A, what is that? B, no, I don't like beta fish.
I can't.
C,
I got
I'd rather do things the hard way. Or D, yes. And the correct answer, I hope, for some of you will be yes. And if you do want to beta test the software, which is absolutely free because that's what it's worth right now, you can go to estateview.link, hit tell it the email address is test@test.com. That's probably, hopefully, the only lie you'll tell that day. Your password is the word test, then you'll click login, and then the lumber will begin. So first, we're going to talk about some hot topics, and I want you to see, hold on. If you're not sitting down, sit down, wait for this. Wow. Now that is not a real fire, that is an animated fire, especially for those of you in California. One thing that I was going to talk to Jerry about when he arrives is the use of private placement life insurance. Private placement life insurance takes those advantageous tax laws that apply to people who buy a permanent life insurance policy, including the fact that your growth and income within the policy is completely income tax free as long as you keep the policy in place through your lifetime. In other words, on your death, all that growth in value, all that income that's stored up in the policy comes out as an income tax-free death benefit. So while the vast majority of permanent life insurance policies are funded through conventional life insurance carriers, where you may have something very similar to a CD or a bond happening inside the policy, or you may have a stock and bond type of account under a variable policy. Under a private placement life insurance policy, you might have an actual operating business or a partnership interest in an actual operating business or rental properties. And the amount of death benefit that you need goes down significantly as you get older. When you see this chart for the minimum corridor test, for a 70-year-old, if you have $1 million in assets in the policy, you only need $150,000 of death benefit. So the expense of maintaining this type of policy for somebody who is age 70 and plans to have a lot of income from a particular investment arrangement, you can consider putting that in a private placement life policy. The client can pull out the amount that they invest income tax free as long as you meet these tests, and then anything above what they invest may come out as loans or just leave them in there. And then if you have a huge event where you have a lot of growth, then you may need to have a lot of life insurance death benefit coverage. So the private placement life insurance carrier enters into a contract with a reinsurance company. They call that a treaty. And that contract says, if your cash value goes up, we will make sure that you have more death benefit. But if you don't want to do that, there is something called a Hampton freeze, where you can say, you know what, the increase in value will take the place of the life insurance death benefit, but I promise never to pull it out during my lifetime. So I call that a hot topic because a lot of people don't really know about it, haven't used it. It's certainly not something you're going to do with a $250,000 or $500,000 or $1 million investment.
I can't hear Alan at all.
If you get to the larger ones, then it works. Josh, how are we doing with Jerry? What's that? Jerry, welcome.
I can't hear Alan at all now.
Okay. So I can hear Jerry, but Jerry can't hear me.
Same problem.
All right. How about if Jerry, I could put Jerry on my cell phone and put him on speaker? Okay. So getting ready for Jerry. Another thing I wanted to mention for those of you interested in estate tax planning is just don't get any more good opportunities in your name. You know, the client comes in and he's got 10 stores and he goes, I'm going to open another 3. These stores are gold mine. Well, have your kids open the next 3. Just provide them with management services, get reasonable compensation. Stop being so wealthy. It's only going to hurt you later. And then for people in the rental business, the leasing business, remember, if you die, instead of a 14-year payment plan, if you're active enough, you can get the 14-year payment plan. If you're inactive, if you're triple net leasing, then you don't get the 14-year payment plan. Hey, Tex, how are you?
Well, no.
Can you hear me?
I can't hear Alan now.
That's really strange. Most people don't want to hear me, at least.
I can't hear Alan now.
Can he put me on a cell phone? Can he call in, Josh? Call in. All right, Jerry will call in pretty soon, and I will keep singing and dancing. So I want to go ahead and cover the second polling question. The second polling question, the 49th Annual Notre Dame Tax and Estate Planning Institute, A, will be on September 20 through September 22nd, 2023. B is held in person and virtual. So you can either go or you can buy the virtual package and see it live or recorded. C gives you 18 hours of continuing education credit, which you can play, by the way, at high speed. Don't tell the regulators this, but if you play it at double speed, we all sound like Mickey Mouse. It's much better, and you can get 18 hours of continuing education credit. D, and this is very important, Jerry, when he's not trying to get on webinars in his spare time, Jerry goes to all the presenters and says, would you like to present? And they say yes. And then he goes, but in order to present, I need you to expand your last paper, or I need you to expand this white paper to a new dimension, something new that needs to be covered for the profession, for the clients, or to take care of new changes in the law. So that's really good. And then E, all of the above. So Josh, is the poll open? All right, so let me know when everybody has answered. E, all of the above. And I don't like fish that much, but I feel that I am floundering. All right, now I'm going to show you the EstateView software. I'm going to find the EstateView software. It's around here somewhere. Let me find it. There it is. It's hiding behind something else. I have too many screens going on. All right. What I did was I went to EstateView.link and I clicked on EstateView.link, and then it asked me my email address. I told a big lie. I said test, T-E-S-T, at test.com. And then it asked me my code name, my secret code name, which I also use for international espionage, is test, T-E-S-T. And then it brought me to this main module. It has nothing to do with the state of Maine. It's the first module that you see in EstateView. And a lot of you have seen this and you're already sick and tired of it, but there is something new, and that is the charitable section, which I will show you in a minute. So I have downloaded the information for this client known as Carl and Billy Olmsted. They have a $4.5 million residence. Maybe we can go stay with them sometime. And on the investment side, I'm going to give them $19 million worth of investments. There it is. So they have 19 million worth of investments. And I'll go here, as you see, 19 million worth of investments. Now they're spending $400,000 a year. They get Social Security income soon, but they don't have it yet. They're retired, not working, so they're spending $400,000 a year. Their investments are making 8% minus fees, minus taxes. Then we will say that Carl will die in 10 years. The residence will be worth $6.6 million. The investments will be worth $30 million. He has life insurance, not in a life insurance trust, of $2 million. On the second death in year 27, the estate tax will be $25 million. And I can change any of these numbers just by scrolling to a place that, you know, maybe 27 years isn't realistic. Maybe we should let them die sooner or later, whatever we want to do. I can take that to 20 years so it's a little bit more believable, but there is a $16 million estate tax issue. Now that assumes that the estate tax exemption is coming down to half of its otherwise applicable value in 2026. Right now it's at $12,920,000, and it'll probably be at $14 million next year. In 2026, it may go down to $7.5 million. But if I unclick this box here, the estate tax issue is not as bad for them. It's $6,916,000, still not so good. But if on the first death, we fund an irrevocable bypass trust that can benefit Billy for her lifetime and never be subject to estate tax at her death, then I've got that estate tax down to $3.5 million if the exemption stays where it is. But if it comes down to half, she's still at a $13 million estate tax. So we recommend that they do some planning. If they do annual gifting for their 4 children, and then they have some grandchildren up the road, that makes a big difference. If they just gift $136,000 a year for 4 children, then by the first death, that trust that they're gifting to is worth $2.7 million. By the second death, it's at $8.4 million, and we got that estate tax down to $10 million. Or if they gift discounted LLC interest using a 30% discount, it's down to $8 million. And if they use a life insurance trust, when I click there, it's down to $7.3 million. And if they enter into an installment sale, which we'll be talking more about, if you see here, they could put $17 million in an LLC, put $1,240,000 into an irrevocable trust, sell the 99% interest in the LLC at a 30% discount for a 4% 20-year promissory note. That's going to move the estate tax down to 0. Hooray, hooray. Or here's an alternative. If they don't want to do the installment sale, then what they could do is just leave the rest to charity. How much would they have to leave to charity to eliminate the estate tax? They could leave $18 million to charity or to a charitable lead annuity trust, which would then be divided between their descendants and charity over a term of years. So we're going to talk about all of these techniques, but just wanted to show you the logistics section, which most of you have seen, and the when we get to generate client letter, if we want to, the computer will write a letter explaining everything that we just did. Gary, a couple of other things that you haven't seen is now we can just have one spouse. By clicking here, you can get rid of your spouse. Now, a lot of people would like to do that. So you just click here. Suddenly, he's single, and still a lot goes to charity. And if you want to eliminate use of any of these techniques, you can just click the box now, and it will be gone. Josh, how are we doing with Jerry?
Jerry's live.
Jerry.
Can you hear me, Alan?
I can. There's a lot of feedback, though.
All right. Well,
Yeah.
I'm on the telephone because I could not participate through the webinar for some reason.
Okay, but have you muted your computer?
Oh, let me,
How's that? He muted himself. Can't hear you. Did you mute your phone?
I just unmuted.
Yeah, it sounds like there's three of you. Should he,
Right.
what do you suggest, Josh? All right. Josh is going to call Jerry, and I'm going to do another polling question. So the
Okay.
next polling question, our third and fortunately not final polling question, is which acronym is correct? A, the Qualified Personal Residence Trust is QPRT. That is a trust that you could put a home or a vacation home into and take a small gift based upon the present value of the remainder interest, have the right to live in the home without paying rent for a term of years, and then if you live past the term of years, the home is out of your estate. That is the Qualified Personal Residence Trust. The second is the GRAT, Grantor Retained Annuity Trust. The Grantor Retained Annuity Trust is a trust that I can put assets into. It will pay me payments for a term of years. And then if I live past the term of years, whatever's left in the trust, which can be a lot, which we'll show you soon, will escape federal estate tax. Then there is the self-canceling installment note, which my dermatologist likes because it's called a skin. And I can sell assets to a trust, income tax free, for a note. The note is higher than 4% that I showed you because it needs to be grossed up so that it's an arm's length transaction according to the actuarial tables. And then on my death, the note is not considered to be owned by me because it cancels. So you can save a lot of estate tax. That's the skin. And then there's the CLAT, the Charitable Lead Annuity Trust, where I can transfer assets and get a full income tax deduction, or transfer assets on my death and have no estate tax inclusion. The CLAT makes annual payments to charity. It could be my family foundation, and will escape estate and gift tax while leaving assets for my family, as we'll be showing you. And then the final acronym is AOA, which is all of the above. So pick your acronym, and then we'll start some demonstrations here on the EstateView software while Jerry works on his sound. Josh, let me know when the poll is over.
There you go.
Alan,
All
can you
right.
hear me now?
I hear you now, and you sound good.
Okay, so let me give a little bit of an overview to EstateView, which Alan and I have been working on for since before the war. Okay, all right. In estate planning, regardless of the technique you use, there's 4 significant factors that deplete your wealth. And the problem is that when you're trying to communicate to a client any of the estate planning techniques you use, a GRAT, a gift, an installment sale, a CUPER, doesn't matter. All 4 of these factors deplete your net worth. And the point is to focus on what are these 4 factors. And the problem is when you try to explain these 4 factors orally to the client, they have problems because we start using technical terms or installment sales, blah, blah, blah. And the key is by using EstateView, you can actually communicate it using simple to follow numerical examples. So what are these 4 factors that deplete your wealth? Well, the most simple factor is I have an asset in a family limited partnership with a capital contribution of 10 million. And I bifurcate my partnership or LLC into voting and non-voting interests, and I can create discounts for lack of control and lack of marketability. So the first thing you look at is I got a $10 million asset in the partnership or LLC, and my 99% partnership or LLC interest is discounted to $7 million. So right away, I give a gift or a sale or whatever of a $7 million asset. So the first factor is discounts. But discounts are not the most significant factor. They work, but you have to look at them in conjunction with all the other factors. So what is the second factor? Well, we call that financial leverage. And financial leverage is very simple. I lend money to a trust. Say I lend money to $1 million to a trust at 4% interest. So that means the trust has to pay me $40,000 a year of interest. And the trust takes the $1 million that I lend them and invests it in an asset that pays 6% or $60,000 a year. Well, the trust owns the asset now. All the trust has is an obligation to pay $40,000. So the spread, the amount of earnings on the borrowed funds of $60,000 over the cost of the funds of $40,000, that $20,000 is also a wealth shift to the trust. So that's the second factor. The third factor is that the trust takes the $1 million and invests it at 6% and earns $60,000. And if the income taxes on that $60,000 happen to be $25,000, the trust doesn't pay it because it's a grantor trust. Who pays it? The grantor. And because the IRS in a published revenue ruling has said when the grantor pays the income taxes on the trust income, they're paying their own debt obligation, so therefore it can't be a gift. So you have the discount, the financial leverage, and the grantor paying income taxes on the trust income. Now the fourth factor, which is not generally taken into account, is every year the individual, the senior family member, has expenses. They have their personal consumption expenses. They have their living expenses. They have all sorts of other expenses. And all the money that they spend on their personal consumption is the fourth factor that depletes their wealth. Now, explaining these things simplistically, separately, is easy, but they all build upon each other and compound. And the point is, as we shift more and more income-producing assets into the trust, into the grantor trust, because remember, the trust can reinvest all of its excess cash. So what happens is that the grantor trust's investment assets increase in value, the income increases, and as the assets in the grantor trust build up, there's more income in the grantor trust, and therefore there's more income taxes. So when you take into account the compounding of all these four factors and the grantor trust factor, which is the most important, you will see that over a long period of time, the grantor having to pay the income taxes on the increased income of the grantor trust is a more significant wealth depletion than the discount or the financial leverage. And the nice thing about it is we can illustrate this in a simple to follow numerical example, which allows you to communicate this to your prospective clients in an understandable manner. Because you're not talking tax speak, you're giving them simple to follow numerical examples. And that is the key, is this, it's developing your communication skills using software. Now, if you want to do it all yourself, you're welcome to, use Excel and put everything in. And the nice thing that we added is when you basically put in a program, you put in all the numbers and you get a spreadsheet that all of those input factors are saved, and then you press print client letter, and you have your first draft of the client letter, and it saves you a lot of time and effort, so you don't have to draft the explanatory letter yourself. The EstateView gives you your first draft. So that's the key. Now, one other factor is if you run something out to, say, age 90, you will see that there is a point in time where all these factors will so deplete the senior family member's assets that they say, enough is enough. Stop this. But the only thing that we can stop is what we call the burn. And therefore, what we're going to talk about later is once you want to mitigate the impact of grantor trust status, we're going to go over about a dozen different ways of doing this. Because when you show the client that they start out with like $50 million, and by the time they reach 90, they're left with $4 million and everything else is in the trust, the client is going to say, I don't want to be beholden to my children. So the key is we have designed a tool that will mitigate the amount of drafting you do and illustrations you do. You get this client letter, and that client letter that we produce is your first draft. And it allows you to communicate all these factors that will enter into estate planning in an understandable manner. And that is what Alan has spent time and time again, and non-billable time, to develop this software. By the way, where do the proceeds of EstateView go, Alan?
Hopefully to you and I, Jerry.
All right. Well, we don't charge. How much is charged? Like, we don't.
I haven't decided yet. I think the first year it's probably going to be $99. You know, it's competing with software that's costing $500 to $600 a year, but we'll see where we land.
I know. So we're going to have a loss leader in the first year.
Absolutely. Absolutely.
So with that, I just got back from New York at midnight last night, so that's why I got a little bit late. But all right. So Alan, now you can go back to all of the EstateView and everything.
Yeah, which calculator, Jerry? You really haven't seen what we've done with these calculators. Which one would you like to see? I've got a Cupid, a Grat, Skin, Clat, private annuity.
Well, let's do the simple installment sale to grant. Well, actually, why don't we just show an outright gift to a grantor trust?
Well, that's, I don't have a calculator necessarily for that, but
okay. So let's do the installment sale to grantor trust, because that's something that everybody understands.
Okay, well, why don't we call it the Skin calculator? Let me show you the Skin calculator then.
Okay.
So
now, a Skin is nothing more than an installment sale to a grantor trust, and when we increase the interest rate, it covers the risk of dying early. So basically, a Skin to a grantor trust is nothing more than an installment sale to a grantor trust at an interest rate that's a little bit higher than the AFR. So
right.
We can use it. Fine.
Right. So over here, we know that the 75/20 rate, which is issued by the IRS based on 120% of the midterm applicable federal rate, is 4.6% this year. And we know that we have to use table 210 for the actuarial aspects of this.
What is table 210?
That tells us the probability of a person dying based upon their age, based upon the population as existed in 2010.
Yeah. So essentially, the IRS is required to use the 2010 census data mortality tables. Now, here is the problem with the 2010 mortality tables. They're 13 years old. They're based on the U.S. population as a whole. So over the last 13 years, there have been significant advances in healthcare, but more importantly, our clients tend to be wealthier than the U.S. population as a whole and will have access to better healthcare. So essentially, if you go in and look at the life expectancy of someone age 70 under the 2010 mortality tables, which is the U.S. Census data, they will say that the life expectancy of an individual age 70 is 15.4 years. Now, what does that mean? Well, that means there is a 50% probability that an individual age 70 will be alive at the end of 15.4 years. So if you just do a financial projection using life expectancy, it really doesn't illustrate the impact of your plan over the client's actual life. So what we allow you to do is put in a projection period that is as long as you want. So for someone age 70 today, 85, they're still going to be young. So you can actually put in your projection to age 90 or 95. But what is interesting is all of the actuarial computations that are done under the Internal Revenue Code use life expectancy. So here's what's interesting is because they use life expectancy, we actually can arbitrage the mortality tables. I'll give you a simple example. If I put money in a charitable remainder trust, retaining the right to the income from the property for the rest of my life, and when I die, the remainder goes to charity. So your charitable income tax deduction for the present value of the charitable remainder interest assumes the charity is going to get it 15.4 years from now. But if you live to age 90 or 95, that's going to postpone the charity getting the property. So essentially, by assuming the charity is going to get the property much sooner than when you're at, and it's actually going to get it, your charitable income tax deduction is actually overstated. And those are the kind of factors that we build on and arbitrage in EstateView. Alan, back to you.
Okay. Well, Jerry, I've got the charitable remainder annuity trust here, but let me, you just mentioned charitable remainder trust. So, okay, this is a charitable remainder annuity trust. So the client can get a life payment. If the client is 67, we can illustrate as long as we want to illustrate it. But the payout rate has to be at least 5% and as much as 6.21. So if the client wants the maximum payment rate for life, we can put that at 6.21. So now we have $1 million contribution, and we have a $307,000 tax deduction, and we are going to see annuity payments of $62,100 a year.
Alan, let me interrupt you. In other words, I put $1 million into a charitable remainder trust, and for all practical purposes, I'm retaining the right to an annuity payment, which is the right to the income from the trust for the rest of my life. And when I die, whatever is left in the trust goes to charity, right?
That's right.
Now, a lot of individuals of modest means cannot afford to give $1 million outright to charity because they need that asset for their living expenses. So they have a bequest of $1 million in their will. And with a bequest of $1 million in the will, you get no charitable income tax deduction. So why don't they put the same $1 million into a charitable remainder trust, retain the same income for the rest of their life, accomplishes the same objective as a bequest, and get an upfront charitable income tax deduction.
And recognition. So that is the charitable remainder.
What's
And
the
then,
advantage of saying to the charity, I just put $1 million into the charitable remainder trust? What are they going to do when it comes to inviting you to all their functions?
yep, yep. And then, of course, you could fund it with your Apple stock that you paid $10 a share for, and it's now worth $3,000 a share, and then defer the capital gains tax on that Apple stock or whatever kind of stock you have, right?
Wait a minute. I have $1 million of Apple stock with a low basis, and I don't want to sell it because I got to report all the gain, right?
Right,
I put it in a charitable remainder trust. A charitable remainder trust, if it sells it, doesn't pay any income tax on its income. Its income is only taxable if it distributes it in the future, right?
right,
So basically, if I sold my Apple stock for $1 million and paid $300,000 of income tax, I would have $700,000 to earn income, right?
right,
But if the charitable remainder trust sells it and doesn't pay any tax, it has the ability to pay you income based on $1 million. So all of a sudden, by putting your asset in the charitable remainder trust, you basically have more you have more proceeds to earn income from you. Wow.
right, right. Absolutely. And then just some of our buttons here, we can either do a life payment or we can do a term payment up to 20 years. So
Now,
if
wait a minute. Why do some people worry about charitable remainder trusts? Because remember, if I'm 65 years old and I did a charitable remainder trust for my life, what happens if I die at, say, age 70? Everything goes to charity.
right,
So they're worried about the unexpected early death. So if they're worried about unexpected early death, you say, hey, look, your mother lived to 101. Why should you be concerned? But if they're worried about that, you do a charitable remainder trust for a fixed term, which means if you die during the term, the remaining payments under that term is an asset that you can then pass on to your family. So if anybody is worried about unexpected death, we'll do a charitable remainder trust for a fixed term.
right, right. So, yep, so you can go term up to 20 years. And then when I click advanced here, it also allows me to say, hey, I think money is worth 6%. So what's the real present value of what I've got here, assuming a 6% discount rate, and over here, it tells me my tax savings and the present value of the annuity right is going to be 836,000. So the amount that really I'm giving to charity conceptually at the time is 315,000. My income tax savings, 37,000. Now this doesn't show the advantage of deferring all that income tax. Jerry, I just want to also show you that for all of these, we have other selections of things we can do, including PowerPoint slides that are coming that will be done pretty soon. So do you want to go ahead and do the skin next? Go back to the skin. So
it's interesting. There's all sorts of little things. When you do this, it gives you the ability to explain all the variables and how to really custom design the technique. And you can do it with the client there, and you can illustrate every little alteration, which is the nice thing about it.
right. So here I've got a 70-year-old, and Jerry, as you said, life expectancy is 15.4 years. So I can run the note at this point with a 15-year note. The gross up on a 15-year note, as you can see here, the applicable federal rate, 3.69%. That's the lowest rate of this month and the last 2 months for a long-term note. And then the interest rate premium, 4.6%. So the total interest rate we're going to have here is 8.298%. So you're typically not going to do this if the person is in great health. You're typically going to do this if they're in not so great health. And now, one thing that, Jerry, as you know, this software does that the others don't is the question as to whether the term of the skin, the note, can be longer than the life expectancy of the grantor. And the answer is yes, it can be. But when I click from 15 to 16, I do get a warning here. And the warning says if you're going past your life expectancy, then the IRS has said that they think it should be treated like a private annuity, which causes the buyer of the note to need to have a minimum net worth. And that's called the exhaustion test that applies to annuities. And here, to do $1 million skin with a 16-year term, I would need to satisfy the IRS, I would need to have $1,420,000 net worth of the trust that I am selling to.
Now, here's the advantage of EstateView. All the commercial programs that do skins only allow you to have the maximum note term be no greater than life expectancy. So if I have someone age 70 with a 15-year life expectancy and I wanted to do a 20-year skin, the commercial programs would only allow you to do the note for 15 years. But there's no limit on the term. It's just, for some reason, it got ingrained and people just accept it. It's like the 10% minimum funding myth.
Right, but the longer the term, the higher the interest rate, which EstateView lets you know. Now, another thing, Jerry, that we have is I may want to do something a little different and look at it. So I can click duplicate here. And now I'm looking at my second skin. So that's shown here on the next line. And let's say that I just want to show a 12-year skin. So now my second skin is a 12-year skin instead of 16. I see the interest rate is different. And then I have the same spreadsheet, which shows me I put $1 million in, it grows at the growth rate I chose, you make the payment, here's what's left in the trust. At the end of the day, the trust is never subject to income tax, so it grows income tax free. I'm not showing the burn here. I'm not showing the burn here, but we do see that the tax savings will be significant. Another thing that I can do, Jerry, is I can change what happens in the spreadsheet. I can select what columns I want the spreadsheet to show. So once I make my selection, I close it, and now the spreadsheet just shows me the columns that I chose. I can also click here to export the spreadsheet. Just became an Excel document. So now I can do whatever I want to do with the Excel document. And then also, once I choose one skin or the other, I can go ahead and ask for a PowerPoint. I can click on PowerPoint, and now there is a PowerPoint explaining a skin and showing the exact numbers that we just chose. So now, not only
They're only going to sell this for $90?
I think so. I think I'd like to have a lot of people using it.
All right.
I don't think the secondary price will be $99. Then there is your spreadsheet in the PowerPoint. So
Let's go back to the spreadsheet in Excel here for a second.
Okay. Yeah.
Now, one of the most important things is what is the years out? Where's the column that lists the value of the assets in the trust that you? Oh, by the way, we always do sales to grantor trust because we don't want an income tax sale. Because if you do a skin to a non-grantor trust, it is basically a sale, and you realize the gain, and then you got to report the gain. So, just like an installment sale to a grantor trust, we do a skin sale to a grantor trust as well.
Right, right. So there's the value after 7% growth and after making the payments. There is the value of the trust.
Yeah. Now, interestingly enough, as you can see here, the value of the assets. Remember, this is nothing more of a way of shifting wealth to the trust. It's, you know, using all the different factors. No, actually, well, I'll wait till we'll go back when we do installment sale to a regular grantor. Do we have installment sale to a regular grantor trust, Alan, yet?
Yes, it's the same one we had before,
Okay.
where you provide, this person's worth 25 million. He spends 800,000. Let's make it, he spends 550,000 a year. His assets grow at 8%, minus, let's say 1% income tax on the value of the assets. He's used up 250 of his exemption. He's going to make a seed capital gift of 600,000 to a trust. He's going to put 6,700,000 into an LLC. He's going to take a 25% discount on the value of the LLC interest. So he's going to sell 99% of that LLC for a $4,400,000 note. It's going to bear interest at, let's say, 4%. Let me go to 4% there, or let's say 4.32%. I'll go to 4. Then state tax rate 40%. Assume consumer price index 3.96. It can be a conventional note or self-canceling. And then the number. What's that?
Don't do self-canceling right now. Just do conventional.
Okay, we'll do conventional. All right.
Now, interestingly enough, there's a very important point. You see, Alan just took a 25% discount rate. Now, most people would say, oh, wait, I'm putting my marketable securities into an LLC, automatically creating a lack of marketability discount, a lack of control discount, and they say, oh, I can give you a 40% discount. Now, interestingly enough, as EstateView illustrates, over a long period of time, the discount is almost irrelevant. Now, the clients are going to tell you, I want to be as aggressive as possible, but at the same time, they're also saying, I don't want to get audited. And since the discount is not the most significant factor, if you compound this over a long period of time, we tell the client, instead of taking a 40% discount, take a 25% discount. Now remember, the IRS doesn't have the ability to audit every gift tax return. So if there is a whole bunch of discounts at 40% and your discount is 25%, what are the chances the IRS will not audit your return and audit the returns with the higher discount?
Does it matter whether it's Hunter Biden that's doing this?
Well, what can I tell you? But the point is, because the discount is a one-time thing and it only has a short-term effect, and we can show you that the grantor paying the income taxes is the most significant factor, you don't have to take an aggressive discount, and that reduces your potential for audit.
Right.
It's a very practical advice.
You know, Jerry, in the old days, when you had an estate tax audit, the auditor came to your office and scared the heck out of you and looked at everything and was really, really smart. We used to have, I think, 3 of them in the Tampa Bay area. Nowadays, it's somebody on the phone and they say, well, you took 35%. Would you mind reducing that to 20? It's a different culture now with these, isn't it?
So basically, they're going to say you took 35, reduce it to 20. So why don't we have a discount of 20 to 25%, right?
Right. Maybe 29.9. Yeah. Whatever. All right. Should we go ahead and play with a Cupert, or do you want to play with a Grat?
Actually, we have a lot to. I want to show the fact of how the assets in the grantor trust, as they build up, eventually produce so much income that the grantors, and we show, and you show in that how much is left in the grantor's other assets that he retains. Do we have that yet, Alan?
No, no. But I mean, I can go
Oh.
back to the main module and have this guy do an installment sale early in his life and have him live for, let's see how long he's going to live here. Have him live for 22 years. And without the installment sale, you've got a $15 million tax. You've got a 39 million exposed to estate tax, even though he's starting with only 23 million because of the time value of money. But if we do the installment sale, then that installment sale trust, oh, I need to click on installment sale there.
Well, wait a minute. There's something very important.
Go ahead.
You're going to say to the client, I want you to do an installment sale to a grantor trust, and it's going to incorporate all 4 factors to reduce your net worth. Okay? And the client really wants to know 2 things within 5 minutes. The first thing they want to know is, this is a great technique, but before you get into detail, they really want to know, how much am I going to save? And by just clicking in the numbers that they give you here, within 5 minutes, Alan shows you that I can reduce your estate tax by millions and millions of dollars. So if I can reduce your amount in your gross estate by $20 million at 40%, that will save you $8 million in estate taxes. And you can do that in 5 minutes without getting into the details. Now,
Right.
Once you show the client, I'm going to save you $8 million in estate taxes, what's the second question the client asks?
How much is it going to cost me to do that?
So I would say, would you like to invest $50,000 to make $8 million over the rest of your life? And they say, of course I would. And I say, oh, by coincidence, that's our fee.
Right.
But no, the point is, when you're illustrating this, you can show the value to the client of what they're doing. And then what they're paying you for is your intellectual and analytical ability, and not just a form that you're filling in the blanks. So it's a way of showing the client that there is real value to what you're doing, but you can show them the actual numbers.
Perfect. So Jerry, let me do another polling question here. All right. Spousal limited access trust stands for all of these things. A, special local alternative tax. B, staying liquid absent taxes. C, spousal lifetime access trust. It's actually spousal limited access trust, but D, all of the above. And I think in preparing this slide, our grade is a D. Not the best slide we've ever done.
All right.
Jerry, do you want to talk about Notre Dame a little bit before we go to more calculators?
Yeah. Notre Dame, I'm a little biased because I'm the director of the Notre Dame Institute. And this year, because it's not that easy to travel to South Bend, Indiana. Now, interesting, Notre Dame is always the Thursday and Friday before a home Notre Dame football game. Unfortunately, the home football game on Saturday is Ohio State. So take it for what it is. But one of the things we do at Notre Dame is when you go to a CLE program, there's all these different sessions, but they're all one after each other. And some of the sessions that are listed, you're not that interested in. Other sessions you're more interested in, but you have to listen to all the sessions. Or if you don't want to listen to a session, you don't have any alternative. We have concurrent sessions and opposite each other So it gives you the choice of which session you're more interested in. So if someone is talking about some topic that you're not interested in, you can listen to the other one. And of course, if you attend in person, you have the ability to purchase all the recordings of every session. But what we have done this year is, because there were a lot of people who attended Notre Dame over the last 2 or 3 years virtually, who said, I never would have come in person because it's just too difficult to get to South Bend, unless you're Irish, I guess. So what we did this year, if you don't want to attend in person, you can also register, and you don't have to attend, and it's not a hybrid. In other words, you're not going to be able to listen remotely to the sessions. What we have done is, if you don't want to attend in person, we will give you all the materials electronically or on a flash drive, and for an extra charge, which is only like $130 over the registration fee, we will send you recordings of every single session that you can then listen to at your leisure. Because this way, you don't have to, like, you're listening and all of a sudden the client calls you and you got to take care of something. So you can attend in person. If you don't want to attend in person, we'll give you all the materials. You won't be able to listen as the program is going on, but you'll have all the materials and all the recordings. Now, it's going to take us 2 weeks after the Institute to get you the recordings. So it's a nice alternative, and I think that is the wave of the future.
I think you're right. Jerry, what are some of your favorite topics? I mean, I see some topics here that I can't miss, that I have to get the materials for. But what are your favorites?
Well, the key is, when we go to a lot of these programs, everything is advanced, and it's almost focused on people who are at 20, 30, $100 million. But remember, half of your clients or more are not going to be are middle class. Now, I define middle class as under $24 million today, because that's the exemptions. So we have a lot of practical topics for Notre Dame. And another topic which is interesting is, one of these speakers is going to talk about financial modeling on all the estate planning techniques, because, in other words, it's a very practical topic, how to communicate using financial modeling and estate planning technique. And that is going to be a specific topic. We also have, even though this is an estate planning conference, we do focus on what we call income tax planning. And, most estate planners, all they think about is step up in basis at death. But there's other income tax factors that are very important. For example, how about assignment of income to taxpayers in lower income tax brackets? For example, if you have a non-grantor trust, you can actually conduit the income out to the beneficiaries who are in lower income tax brackets. And interestingly enough, there's a rule that if you have a capital gain and your income is very low, the first few $100,000 of your capital gains is subject to no tax. So suppose the trust has a appreciated asset that it's going to sell and realize like $1 million capital gain, and it's got beneficiaries who have very little taxable income. Distributing that capital gain to those beneficiaries means they can report it, and if they're in that bracket where there's no tax on capital gains, that's what we call assignment of income to taxpayers in lower income tax bracket. Now, the other thing is, as we can show you, as Alan kind of showed you in the charitable remainder trust, if you sell an appreciated asset, you're going to have to pay tax on the gain. If you put that appreciated asset in a charitable remainder trust, the charity doesn't pay any tax on its capital gain, and it's only reported when it's distributed. So let's suppose I put a $1 million asset with a zero basis, marketable securities, into my charitable remainder trust. And the individual retains a 5% interest. So $1 million, say, retains them the right to an annuity of $50,000 a year. Okay? And, I'm sorry, they retain an annuity, say, of $80,000 a year. The charitable trust sells the asset for $1 million, takes the $1 million sale proceeds, and puts it into a high-grade corporate bond that pays $50,000 of interest income each year. But the charitable annuity is $80,000. So the charitable trust has to distribute to you $80,000. But if the income is only $50,000, the other $30,000 is an invasion of principal. And that $30,000 invasion of principal has all the built-in capital gain from the sale of the appreciated asset. So essentially, every year, you're going to report $30,000 of that capital gain over like 20 years. So essentially, contributing an appreciated asset to a charitable remainder trust allows you to invade principal, and over time, you can defer the reporting of your capital gain from the sale of marketable securities. And there's no risk to it, period. And
Excellent.
so those are the kind of topics that you don't see at regular programs that we're going to focus on at Notre Dame. And I have the ability of having dual sessions. So even though it's 8 hours a day for 2 days, you think that's 16 hours, but there's 32 programs.
There's so much substance in your programs too. They're just excellent. You could go to 20 hours of another program and not get so much. And of course, the profits from this go to Notre Dame University, right? So
and they don't go to the athletic department. It goes to the law school, where they use it to fund the law school pro bono activities.
Oh, nice, nice. All right, I'm going to do.
By the way, one little vignette. In South Bend, which it's a Catholic school, even though half of the students aren't Catholic, and two of my speakers were Orthodox, and so they kept kosher. And I was able. There happens to be a kosher restaurant, a kosher delicatessen run by the Chabad group. I was able to give them kosher meals while in South Bend.
Oh, that's fantastic. Very nice. All right, so here's another polling question. Under the reciprocal trust doctrine, A, if each spouse forms a trust to benefit the other, then they may both be subject to estate tax. B, there are court decisions that permit this, but use extreme caution, or at least that's my opinion. Our law firm actually doesn't do reciprocal trusts. C, it's safest not to have reciprocal trusts. So the answer is any of the above, A, B, or C.
Alan, you raised a very important point. You don't like reciprocal trusts because it is basically an automatic audit when the first spouse, when the person dies.
Wow.
And if you don't, pardon me?
Yeah, I hadn't even thought of that. Thank you. That's important.
And if you don't do it right, you can screw it up. And,
yeah.
and what we show you essentially, and we can show you this using EstateView, is there are ways of having the spouse who creates the SLAT for the benefit of his, remember, husband creates a trust for the benefit of my spouse and my descendants. And some husbands are worried about getting divorced, but to be honest with you, most of our clients are married and they're very happy. Their big concern is what happens if my spouse predeceases me. That's the biggest concern. Because then, and you show all that buildup in the grantor trust, and they say there's too much assets in the grantor trust. But what we can do is show you there are other techniques that are available where you can actually have the beneficial enjoyment of the trust, and that is, in other words, we're hedging you. We don't put everything into the slap. We use some other techniques where you can have the beneficial enjoyment without the risk of having reciprocal trusts. And then of course you can illustrate that using EstateView of all these other techniques to see that. So that's why we don't like reciprocal trusts.
So I got to show you a new feature of our webinar capabilities. So, all right. So back to EstateView. What calculator would you like to see next, Jerry?
Well, the problem with GRATs is you can't do GRATs for a long period of time because of the risk of dying during the GRAT term.
Yep.
So, and I don't do GRATs because of that risk, because there's so many alternative techniques.
That's interesting. Let me ask you, if you have a client, if I had a client come to me with 400 million, I would probably do the installment sale on half of it and then the other half in a GRAT. The reason being that if I do that big of an installment sale and the IRS comes and doesn't like my discount, even if I only use 25%, that client's going to owe a lot of gift tax. I mean, even if I use a Wandry formula clause, we know the IRS doesn't like those clauses. But you think it would be fine to take a $400 million person and put most of the assets into an installment sale?
Yeah, see, a $4 million person, see, the GRATs are great if you have a volatile portfolio of marketable securities that can go up and down and you don't know, and you do the two-year rolling GRATs, because they have a price they have the price readjustment language in the statute. That's why I always say, to reduce the risk of the IRS challenging your discount, just take a smaller discount.
Right.
But the problem is, I can't see on an installment sale to a grantor trust. I get the benefit of locking in everything over a long period of time. And when interest rates were really low, like when the AFR was like 2% and the 75/20 rate was really low, a long-term installment sale locked in that low discount rate, that low interest rate for 20 years. So if the AFR went up to 5 or 6%, where it's about to go now, I've locked in a 2% AFR for 20 years. Oh, by the way, one of the topics that we are having at Notre Dame is what techniques are very viable and work in high interest rate environments. And David Handler is going to show you a number of techniques that even if the AFR or 75/20 rate are very high, they work better in a high interest rate environment than a low interest rate environment. So I just thought I'd throw that in.
So Jerry, just so I remember to tell you, for the GRAT and the skin, if you decide you're putting in $1 million, that's fine. But if you want to put $1 million into an LLC and then transfer a discounted interest at a 25% discount, then it shows the result of that, which is a better result, of course. So that would be result number 2 there. The other thing I wanted to show you. By the way, go ahead.
Alan, you have a column there, way on the right-hand side, probability of survival. In other words, there's a lot of information that the commercial programs do not provide. And the client says, you know, I'm 72, you know, what if I live to 83? So you can show them the probability of being live at 83 is still like 58%. So what we do here is we provide you information that is always helpful in explaining the technique to the client. And you don't have, and it's there right in the tables.
Right, right. By the way, for Jerry, for all the calculators, we've also got timelines and charts. So, well, this one doesn't, I guess, but for many of them we do. Let me go to the Cupert just so you can see the Cupert because it works really well. 70-year-old chooses a 10-year term, has a $2 million home. The home's going to grow, let's say, at 3.53% a year. So you see here that the gift amount is 45.7%. So the gift tax exemption used 933,000. That comes back if the client dies during the 10-year term, but if the client survives the 10-year term and the home grows at that growth rate, then you've got a $2,800,000 home and you've saved estate tax of $1,130,000. Now, I can be fancier here. I can go to advanced and I can project a later date of death. So you can see the time value of money savings there. And by the way, when you show the Excel chart, you can show every other line or every third line to make it bigger, if that's what you prefer to do. Or what if this person only gives half of the house? So I go with a 50% interest and a 15% discount. Now, if I crank the discount up, we get a warning. When you discount partial ownership of real estate, we think anything over 20%, you should think twice. It's based on state law. There is a Florida decision at 15%. And then some nice things here. This will, and I can do this with multiple, but this will show me in blue what's going to be moving outside of my estate there, but in red it shows me the risk of my dying during that period of time. So it helps me compare the two illustrations. One illustration, of course, can be different than the other. I could show a 14-year term. So you can just see here a 14-year term for a 70-year-old. You've only got a 57% chance of living that long, but a smaller gift. And then the other thing I can do is I can add rent. Well, after the possessory term, they'll start paying rent, and the rent will reduce my estate for estate tax purposes. In fact, the total amount of rent would be $700,000, which would be a further reduction. And then here I can do a chart that shows me the assets subject to estate tax, not subject to estate tax, comparing the different Cuperts I've done. This shows me each separate Cupert and what the total rent has been, what the impact of the rent can be. Pretty nice thing. So, and then
what's important about EstateView is when you use the commercial programs, they're narrowly focused. You do a Cupert, they kind of just limit all of the assumptions, and by having all this little extra stuff, it sensitizes you to issues and factors that you might not normally think about when you're doing the proposal. And what this forces you to do is think about all these other little details that are going to come up in the design of the structure, that if you're just doing a presentation without something like this, you might not think about all these little extra things that have to factor in. So what it does is it's a resource to sensitize you to all the little different factors that have to be addressed when you do any one of these techniques.
Right. And Jerry, as you can see here, we're working on general explanations, short explanations, planners, checklists, PowerPoint presentations, sample provisions that will all come with this software when we're ready.
We should charge $2,000 a year for it.
I agree. I agree. But then here you have an explanation with the numbers in it. You've got a PowerPoint for each Cupid I just did. You have a checklist that comes out as a Word document and a general explanation document as well. So the PowerPoint shows you the house, and then it shows you the numbers, the whole thing.
I mean, the amount, what we're doing here is producing all of the stuff you otherwise would have done from scratch by hand.
Right, or that you wouldn't have done, and the client, everybody's estimating. So Jerry, when we do a qualified personal residence trust, we normally have each spouse do one with half the house. One is basically a slat. It says I can live in the Cupid I just formed for my wife Marcia for the first 10 years. After that, it's for her health, education, maintenance. Then the Cupid that Marcia would fund with the other half of the house would be for our descendants only. Now, I hear that some people are doing joint and survivor Cupids, like a joint Cupid for 2 lives, which we can do here. I can definitely do a 70-year-old and 75-year-old and see how that's different. But what are you normally seeing? And are you doing Cupids?
Well, actually, in today's environment, with the higher interest rates, the remainder interest, remember, the discount rate with the higher remainder interest, the remainder portion becomes, the remainder interest with higher 75/20 rates, the remainder interest becomes greater, correct?
Right.
So
right.
when the 75/20 discount rate was less, the remainder interest was less. And when you have, residences in the $5 to $10, $15 million range, the amount of the remainder interest is the most significant factor. Because remember, if you die during the term, the whole thing's included in your gross estate. So you always want a term that doesn't have any risk of you dying during the term. So again, the more valuable the property is. So there is an alternative to a Cupid, by the way. And
Yep.
It's actually very simple. You sell the house, you get a value for the house, you sell the house for adequate consideration to a grantor trust for an installment note. And then you lease it back. So it's nothing more than a sale-leaseback transaction. Now, estate planners say that's very risky because you're living in the house. But essentially, it's a transfer for adequate consideration. So the nice thing about it is if the house is subject to a mortgage, you don't have to redo the Cupid every time there's a principal payment on the mortgage interest, on the principal that's paid on the mortgage interest. So one of the alternatives is when you show the differences between the Cupid, because remember, the Cupid is not going to have investment property producing income. So the only thing that you have to be aware of is, and this is very interesting, I can sell $1 million house. Say I value the house at $1 million. I just use $1 million because it's a nice even number. Make it $10 million. I sell my house to a grantor trust for a $10 million promissory note, payable interest only with all principal due in 20 years. And the interest rate is 4.6%, right?
Yep.
and I've locked in that interest. The only thing is, the rental on the house is not going to be a market rental on that house is not going to be 4.6% of its value. It's going to be significantly more. So if I do a $10 million house at a $460,000 interest payment, the rental would be more like $1 million a year. So you can actually, and you go out and you get a real estate broker to tell you what a fair market rental is, and you pay that fair market rental. In other words, I'm getting 4.6%, but I'm paying like 7 or 8% of the value in fair rental, which a Cupid can't take advantage of.
Well, the Cupid can receive fair rental payments for the
after he died, after the term is over.
Right, that's right. I see.
And I can start that arbitrage immediately, because, and people don't think about that.
Yeah. Also, what do you think about the life estate remainder interest purchase if it's a new home that senior's buying and junior puts up the sufficient amount for the remainder interest, senior puts up the life estate? That should work, right?
That should work. The only problem is it's a little bit more complicated to explain to clients.
Right.
And remember, we have to keep it simple.
Right.
That's our goal. How to explain this stuff in an understandable manner.
Right. Right.
Yeah.
Okay.
The point that Alan's making is, you have a client and there's different techniques that can be used for that client. And using something like EstateView shows you the financial impact of each technique. So that gives you the ability to determine which of the available techniques is most appropriate for a particular client situation. Remember, it's all in the analysis, and this allows you to do the analysis in a more efficient manner.
Right.
Okay.
Right. And it's interesting because when you run the numbers, it's not always what you thought it would be. All right, Josh, are we showing the all right, here's the polling question. IDGT stands for A, what you do after a mosquito bites you. B, irrevocable domestic grievance trust. I think I have one of those. Or C, intentionally defective grantor trust. And the right answer is D, because there is no D, or you could pick any of these. We're in Florida, so we know all about the mosquitoes.
Alan, there's another trust you should use. It's called a honeydew trust.
What is that?
You don't know what a honeydew trust is?
No.
It's when you go home and your wife says, honey, do this.
It's funded by this trust?
I just thought I'd throw it in.
Yeah, yeah. All right, so Jerry, we've got half an hour here, and we haven't gone over the CLAT or the private annuity calculator. Which would you like to do first?
The private annuity.
All right.
Now, interestingly enough, estate planners typically do private annuities for people in poor health. Okay? And the idea is they're going to die during the term. And of course, if you do a private annuity for someone in poor health and they die within a year or two, it's an automatic audit, and the IRS will give you a hard time. Sometimes you'll prevail, sometimes you won't prevail. Okay? Now, let's take a client with $25 million of investment assets. The spouses have $25 million of investment assets. Okay? How much of their investment assets would someone typically commit to one of these transactions? Not all of it, right, Alan?
Not all. No.
They would. A lot of clients will say, "I got $25 million. I'm willing to put 20 million into all your techniques, but I'm going to keep $5 million. And I say, but you fully utilize your gift tax exemptions. You're going to keep $5 million of income producing assets. That means you're intentionally going to expose $5 million to 40% estate tax, and it's going to cost you $2 million. And they say, I don't care. I want the guarantee that I'm going to have the income from that $5 million for the rest of my life. And it's typical. They're always going to say that. So we recommend, and they've already funded a trust with their gift tax exemptions, with lots of assets in the trust, right? So basically you say, why don't you take that $5 million of investment assets, and you want an income interest from that $5 million for the rest of your life. So why don't you use that $5 million to purchase an annuity for the rest of your life? And they say, yeah, but I don't want to go buy commercial annuities. I'm saying, no, you're purchasing the annuity from your grantor trust. And by the way, you've already funded that grantor trust with other assets, so it meets the private annuity exhaustion requirement. So you don't have, so essentially, I put that $5 million asset in, and the IRS basically tells you exactly what the annuity payment is, and that annuity payment will be payable for the rest of your life. If you live to 105, you're still getting the annuity payment. If you unexpectedly die early, it becomes an estate planning windfall. But the point is, it's a private annuity for a healthy individual who we expect to live a long time. So, wow. How many people do you know that do, Alan, how many practitioners do you know who recommend private annuities for healthy individuals who are going to live a long period?
You and me. That's who I know. So that's who I know does them that way.
And Ed Wojciechowski, who wrote the private annuity portfolio for tax management.
And
Okay.
such a brilliant guy and a wonderful gentleman. Yep.
So the point is, and by the way, someone says, well, if I do a private annuity, the IRS takes a position that you have to realize the gain. I say, yeah, that's if it's to a non-grantor trust. But if it's to a grantor trust, there's no income tax sales, so you don't have to worry about that. So the private annuity for a healthy individual gives them the financial security of knowing that if they live way too long, they're always going to have the financial security of that annuity payment for the rest of their life, even if they live to 110. So the key is, but there's an estate planning advantage to a private annuity because it is, you're selling an asset at the 75/20 rate, and if you can invest it at a greater amount, you have the financial leverage spread. So that's what Alan now has with the private annuity calculator. Okay, Alan?
Right. So Jerry, just so you can see that I can defer the first, right now it's showing, let me go back to non-deferral. Where was that? Okay. So right now,
actually, Alan, hold it. If I'm age 70, I probably want an immediate annuity, right?
yep.
But if I'm age 65 and I'm going to work another 5 years, I would want a annuity starting date that's deferred until I retire. So we give you the choice of the calculations.
Right. Right. So, and then in addition, you may want a level annuity, or you may want an annuity that starts a little lower and goes up.
Why would you want an annuity? Why would you want an annuity that increases like 1% or 2% a year, Alan?
Well, to keep up with inflation, peace of mind.
Exactly. Exactly. You don't want to do a linear, because you want that annuity to provide them for their personal consumption. And as their cost of living goes up, you want the annuity to go up as well.
Right, right. Now, Mrs. Kite was not going to get a payment for 10 years. She deferred, I believe, 10 years, and she died, what, 3 years into it. So is that safe to defer for 10 years, or what's the Hesch rule of
Well,
thumb on that?
the Hesch rule of thumb is I want to do private annuity who people are perfect health for a person of their age, because they, in the Kite case, the IRS challenged it because and they lost because the court said we look at the state of her health at the time she did the annuity. Now it turned out Mrs. Kite had a number of medical conditions, and the reason they did a deferred annuity starting date was the doctor was able to say there's more than a 50% probability she'll survive 2 years. But but if you also looked at the medical records, there's a significant possibility she would die before the annuity starting date. The IRS challenged it and lost because they looked at the health at the exact same time the annuity payment was issued. And we're talking about people who are good to average health for people their age. Okay? And we expect them to live a long period of time.
Okay, now
You don't have the risk of Mrs. Kite. Now, the problem is if your client unexpectedly dies within a year or two, the IRS is going to challenge it. But you have the medical records that show at the time of death the annuitant was in perfect health for a person of their age, and that's all you need to show. And if you look at all the private annuity cases over the years that the IRS challenged, it was all a function of evaluating their health at the time the annuity was issued. Of course, too many estate planners. So, and that's right there in the statutes or in the rulemaking regulations.
Okay. So Jerry, what I've read from Ed's portfolio is you could do the private annuity as long as there is no disease that would take you down within a year. Basically, you have better than a 50% chance of not dying from any particular disease within a year. So in other words, if you have 3 diseases and you really have a life expectancy of 4 months, but each separate disease would not be expected to kill you within 6 months, you can do the private annuity. And
that's pushing the envelope.
Pushing the envelope, which some clients will want to do. Secondly,
I like doing it for people who are healthy. Say, I need to keep a certain amount of principal to provide me with my living expenses. That's the perfect candidate for a private annuity because you don't have any of the medical risks.
Now, Jerry, if the private annuity transaction is with a trust, then in my example here of a $5 million annuity for a 65-year-old, the trust has to be worth at least $12,352,000 to satisfy the regulatory exhaustion test. My first question is, how many practitioners believe that exhaustion test doesn't have to be followed because of technical issues relating to its promulgation?
I got a question. How many practitioners are aware of the exhaustion test? I've had practitioners tell me all you need is 10% minimum funding. Okay?
Yeah. Well, the IRS says you have to have enough in that trust to make payments based upon a 75/20 rate of return until they reach age 110. I've never met anyone who got to 110. That part of the regulation, to me, seems unreasonable. I don't know that anyone's challenged it in court.
Well, first of all, unfortunately, when Congress enacted Section 7520, they delegated to the Treasury Department the authority to promulgate regulations that have the force of law. So you have to show it's arbitrary and capricious. However, insurance companies when they issue annuities, reinsure their risks. So in the real world, insurance companies can meet an exhaustion requirement by reinsuring their risks. So all that the exhaustion test says is that the trust has to have access to, say, $12 million. So you know what we do? We use guarantees with somebody who has the financial ability to make good on that guarantee. Because in the real world, that's nothing. The insurance companies reinsure their risk all the time, and factually, all that you're required to do under the exhaustion test is show that the trust has access to the amount in those reserves. And one way of having access to those reserves is to reinsure the risk by getting people, other trusts or other people to guarantee it. Now, who's the best people to guarantee it? It turns out the beneficiaries, because they have a vested interest in the success of it. So if you can't meet the reserves, oh, by the way, Alan, the client says, I only funded the trust with $6 million. I can't meet the exhaustion test. So what we do is we cut the annuity in half. So it's not the full annuity. So what we do is we say if you got $6 million, we back in to what the annuity should be based on the amount of reserves that you have committed. So you don't have to do it for everything. You can just cut the, in our situation, I can do an annuity for $2.5 million, and all you need is $6 million.
And then you could do a skin for the rest or something else for the rest.
Remember, a skin is not an annuity. A skin is a debt obligation. And there is no, and as a debt obligation, it's just like, remember, a skin is nothing more than an installment sale to a grantor trust.
Right, right. Okay.
Yeah. And by the way, is an annuity is a bet to live the way we do it, because we do it for healthy individuals. We also do skins for healthy individuals. Now, why would you do a skin for a healthy individual? Well, it's very simple. A skin is a bet to die. So I basically do a hedging transaction where I do half with a skin and half with an annuity. And if he lives, the skin gets paid off. But here's the thing on a skin. When you show the client the burn from grantor trust status, they say right away, I don't want to pay all those income taxes. How can I mitigate the burn? And you say, well, the AFR is only a minimum. And under the high yield debt obligation thing in the income tax under 163E, you're allowed to increase the interest rate on a sale by up to 5%. So if the AFR is 4.6%, I can make the interest rate 9.6%. Now, in your example, you showed it at the skin with the risk premium was 8.6%, right?
Yep.
So why would you want to, so basically you got a skin for a healthy individual. And what you're doing is, in the event there's an unexpected death, which we hope never occurs, it's a bet to die early, and you have that tremendous estate planning windfall. And he's healthy, so you don't have to worry about the challenges. And the thing is, by increasing the interest rate, that gives more cash back to them, which means the less they have, the less of their own cash they have to invade to pay for the burn caused by grantor trust status.
Okay, next polling question. By the way, Jerry, that was fantastic. I have one more question on private annuities. If you do a private annuity with a person instead of a trust, there's going to be income tax, but is there any income tax if you die before the first payment?
No, it's like you bought a commercial annuity and you die. Goodbye, it's gone.
Yeah, well, so that's why Mrs. Kite waited 10 years, because they figured they didn't want to pay any income tax on what would have been owed to her.
Yeah, I mean, it was, Mrs. Kite was overly aggressive, and even though the IRS respected the annuity, they basically found that it violated Section 2519, and they lost that way. But you don't have to be aggressive. You do your private annuities, and you do them legitimately. The deferred payment was there because I want the payments to start when I retire. Okay. Alan, I lost your sound. Alan, raise your hand if you can hear me. I can't hear you for some reason.
How did I mute myself? Is that working?
Oh, no. I can hear you now. Great.
All right, sorry about that. All right, the estate tax A is a voluntary tax. If you don't plan, you have to pay it. You might have to leave a little charity to get out of it. B, the estate tax is a 4% flat rate for federal. C, the estate tax is not your friend. It's my friend, though. And then D, all of the above. Thank you for having a warm pulse to pass these difficult exam questions. All right. So Jerry, I wanted to talk about the CLAT. We've got 11 minutes for the attendees. We have longer if we want to.
A CLAT is nothing more than a GRAT, but the annuity goes to the charity. So all of the factors that you use for GRAT, valuation discounts, and having the annuity, the financial leverage, that the annuity is based on the 75/20 rate. So a CLAT does the same thing. It basically, it gives you all of the same advantages of a GRAP, but the key is the annuity goes to a charity, not to you. So if you die during the CLAT term, well, the money's going to charity, you don't own anything. There's nothing in your estate. So since a charitable lead trust is nothing more than a GRAT, but the client says, wait a minute, if I had a GRAT, I would get the annuity, and in my situation, I am going to give the annuity to a charity, so I don't get anything back. Why should I do a CLAT as opposed to a GRAT?
Right. Well, if I want to give something to charity and get 100% deduction as if it all went to charity, even though a lot of it's going to go to my family, then the CLAT is for me. Or if I want to make a donation of assets to be used for charity for 10 years, get $1 million deduction, and actually some of it may come back to me after the 10th year because of how the CLAT rules work. That would be my answer.
Here's the first thing you do, okay? You ask for their income tax returns for the last several years, and you see every year they're giving significant amounts to charity. So basically you say, when you give significant amounts to charity, you don't get the advantages of discounts and financial leverage for estate planning purposes. So instead of giving the amount you give the charity outright every year, put the income producing assets in your charitable lead annuity trust, give the same amount to charity each year, get the same income tax deduction from a present value point of view, and get the estate planning advantage. So a lot of people that are already giving significant amounts to charity each year, even $50,000 a year or $20,000 a year, are prime candidates for a CLAT because it's a no-brainer. With a CLAT, giving outright to charity, you don't get any estate planning advantage. All you do is get an income tax deduction. You give it to a CLAT, you get the estate planning advantage, and you still get your income tax deduction.
Right, right. So Jerry, just to show CLAT number 1 here. CLAT number 1, $1 million goes in. The annuity amount, it's a 10-year CLAT. The annuity amount is $124,000 a year. You get to treat it like you made a full $1 million transfer to charity, but your children at the end get $246,000 back. If I do the same
What they do is using the 75/20 rate as the discount rate, they basically say, remember, it's all income for 10 years at a charity, and at the end of 10 years, the principal goes. So essentially, they determine the present value of the future annuity payments, subtract that from the $1 million, and that leaves that the remainder interest is worth $246,000. So essentially, you report a taxable gift of $246,000, no gift taxes if you have exemption, and you get the estate planning advantage of using the discount and the financial leverage. So basically, and what you can actually show is if you, by the way, you can do a CLAT for 15, 20, 30 years. And a lot of people say, but you know, I'm 70 years old, and the nice thing about it is they're still going to live another 20 years. So basically, you can do a CLAT for 20 years so that what goes to your children goes to the children when you die or expect to die. And the nice thing about a CLAT is you can start the compounding of the estate planning spread while you're alive.
Right. So Jerry, just to show you, you can, right now it's showing these as grantor CLATs. So we're showing an income tax savings, and then we're showing what's the present value of the income tax savings and the remainder going to my family. It's about half based on a 10-year straight payment CLAT. With a 15-year straight payment CLAT, it's about 62%. So pretty good. If another type of CLAT will increase the payments every year by 20, and I can show you that here. I'm on CLAT number 5 here, as you see, and I can either have equal annual payments that are level, which would be $74,000 a year for the entire lifetime of this 60-year, of this for the number of years, for 20 years, or I can have it increase by 20% a year, in which case you can see that the remainder interest will be larger, or I can go with the shark fin. I can click on shark fin and have the initial payments. You'll see that the initial payments will be $5,000 a year, with a final payment in year 20 of $2,000,001. And with this one, you are seeing a much more significant value of the remainder interest. So, but then I can even make it better, because I could transfer discounted assets. If my million is valued at 800,000 because of a 20% discount, now my remainder interest plus tax savings is a lot more than half compared to what's going to charity. So I went really fast through that, Jerry. I'm sure you have a lot of wisdom here.
Well, the key is, remember, a CLAT is nothing more than a graph. In every GRAT, you put a discounted asset in. And the point is that both in a GRAT and a CLAT, it assumes it's going to earn income at the 75/20 rate, and you have to beat the spread. So if I discount the asset, I have the extra discounted amount beating the spread. And the other advantage is the longer you can keep the trust principal in the trust, the more investment rate of return you get. So if I have a level payment charitable lead annuity trust, I'm going to deplete a level amount each and every year. If I have the payments increasing, I don't deplete any. I don't have to deplete any principal. And if I do a shark fin CLAT, I'm not depleting any principal. So I have more principal compounding for the financial leverage spread to shift wealth to the remainder interest in the charitable lead annuity trust. And the nice thing is you can illustrate it with the numbers, because my explanation might have been a little too quick and confusing as well.
Right. One thing I've always wondered is it better to take the discount when you're reducing your income tax deduction? And the answer is yes. It's better to take the discount because the estate tax savings is worth more than losing 20% of the income tax deduction. So lots of fun to be had. I want to do the final polling question for those of you who are wanting to leave but want to get a final polling question in. Do you love learning about hot topics in estate planning and estate tax planning? A, no. B, hell no. C, yes. And I can go to I can go to EstateView.link, testatTest.com, and test are the passwords. Or D, I'm sorry, what was the question? Clear as mud.
All right. Well, Alan, I thank you for all the time and effort you put in here, and all the non-billable hours you spent developing this. But the main point is it's designed to help you fully understand the financial impact of all these structures that you're recommending, so you can decide how to fine-tune the structure to maximize the client's objectives. And then it makes it easier using these illustrations to explain stuff to the clients. And third, all the excellent tenor, once you do it, you get all the documents, not the documents, but all the explanations you knew. Now, for those of you who are a little overwhelmed with EstateView, remember, you can always reach out to your grandchildren to help you with EstateView.
Right. Exactly. Well, Jerry, thank you so much for your mentorship and all the work you've put into EstateView. Thanks for all you do for the Notre Dame Tax and Estate Planning Institute. If anyone has any questions for Jerry, you see his email address there, jhesch@metzlerlip.com. And I hope everybody has a fantastic rest of your weekend. We will be sending everyone a copy of this video. Please send it to anyone you like. And we really, in the words of Steve Lineberg, hope that what we do here will help you to help others.
Thank you, Alan.
Thank you. Oh, good.
Okay, I'm leaving.
All right.
Oh. Alan, are you still on the phone?
Yeah. Yeah. Are we?
Yeah.
What's with Josh? Are they hearing her?
Well, I just logged out of the program. But
Okay.
remember, I'm on my office phone.
Oh, okay.
It's amazing. Doing this alone is not as effective as having co-presenters. It really makes a hell of a big difference on this. Hello? I guess we're off.